Greetings, my name is Zachary Fillingham and I'm the lead analyst here at Geopolitical Monitor. In this analysis video, we're going to be discussing a recent article we carried on the publication examining the state of U.S. government finances. You'll find the link to the article in question in the video description. We'll start with a brief synopsis of the article, which centers on recent 30-year projections from the Congressional Budget Office. Broadly speaking, these spending projections paint a pretty bleak picture for medium-term U.S. fiscal health. This graph puts the U.S. public debt into historical context. You'll note that the debt levels relative to GDP are higher than they've been since World War II, and that they're projected to climb to historically unprecedented levels absent a major spending course correction in the decades ahead. Elevated debt levels mean higher servicing costs for future governments, with consequences for domestic politics, for example, Social Security, and global geopolitics as well, for example, through reduced U.S. military spending. So why should we all care about this? There are a few reasons. For one, the CBO is about the closest thing we have to an independent arbitrator in U.S. politics. It is the so-called fiscal umpire that costs out the policy proposals of both parties. Of course, this doesn't mean it's infallible, but the missed calls generally stem from modeling errors or black swan events rather than attempts at political manipulation. All told, when the CBO talks, U.S. politicians tend to listen. Two, the amount of debt servicing payments under discussion here are extremely consequential and quite possibly destabilizing. Best case scenario is that future U.S. governments make political adjustments to raise revenue, cut spending, and curtail debt accumulation. But even under this best case, contentious policy trade-offs will be necessary. Consider this graph outlining the CBO's projected outlays through 2050. There are a lot of things happening here. For one, net interest is growing from a relatively low level of approximately 1% of GDP in 2020 to around 5.6% in 2050. Meanwhile, entitlement spending on healthcare is growing as the population ages, and discretionary spending, which includes the defense budget, is actually shrinking. Translated into the political vernacular, this means less money to spend overall, combined with fiscal pressure to cut defense and Social Security spending. It doesn't make for a terribly appealing political platform, which further suggests that preemptive action to right the U.S. fiscal ship is actually unlikely. So this brings us to the other scenario of a more systemic risk. Under this hypothetical, liabilities continue to accumulate, with new debt increasingly paying for old debt, until a breaking point is reached in the form of a crisis of confidence and default. Of course, given the central importance of the U.S. financial system and U.S. dollar to global finance, the fallout would certainly not be limited to the U.S. context. In essence, the lifeblood of global trade, the greenback, would no longer be viewed as a safe investment, and what, if anything, could replace it is simply a matter of pure speculation at this point. Though still unlikely, there is a path to this worst-case scenario, because the U.S. government's borrowing is sustained by market faith. As we know, the U.S. enjoys an exceptional status in global debt markets due to the liquidity of its currency and its utility as a foreign exchange reserve. Yet this won't always necessarily be the case, and there are both internal developments, for example, a constitutional or political crisis within the United States, and external developments, for example, a movement to price commodities in alternative currencies, which could elicit a collapse in investor appetite for U.S. treasuries, in turn spiking yields and risking a fiscal crisis. One recent example of just how quickly the winds of change can hit debt markets is the mini-budget affair in the United Kingdom, which ended up sinking not just an entire policy platform, but Liz Truss's political career as well. This brings us to one last point on the CBO projections, and that is just how important interest rates are in terms of assessing these future fiscal risks. The CBO assumes an interest rate baseline of 4.2% in its projections through 2054. As you can see from the graph, this would be a stark underestimate in the monetary context of 1970 to 2007, and an overestimate for the post-Great Recession years. Moreover, whether stated or unstated, there will be an ongoing political pressure on the Federal Reserve to maintain low rates so as to keep the U.S. debt load as manageable as possible for whatever government in power. Where this leaves the direction of interest rates going forward is anyone's guess at this point. However, The ultimate direction of these rates will go a long way in determining Washington's fiscal outlook going forward. The higher the rate, the greater fiscal risk being faced by future governments. So that about wraps it up for this week. If you found this video interesting, we would be greatly appreciative if you could like and subscribe. And this video just scratches the surface of some of the content in the article. For a more in-depth look at these CBO projections and the geopolitical ramifications involved, please feel free to check out the article in the link. And be sure to have a great day. Thank you.